Today's episode of the Energy Question podcast is brought to you by Enverus. The energy industry faces challenges every day, and the events of the last 2 years have caused massive disruptions like never before. Companies in the energy industry need actionable intelligence and a single source of truth that brings all the data together. Enverus is the energy specialized technology partner that provides intelligent connections for a global energy ecosystem. Only Enverus has the analytics, people, experience, and industry scope to connect the right data and information in the right way to discover missed opportunities and deliver fast outcomes. Find out more at Enverus.com. That's ENVERUS.com.
Hey, welcome to the Energy Question with David Blackman. I'm your host, David Blackman. And our sponsor today, as it always is the great corporation, Enverus, energy and analytics firm giant here in the oil and gas and energy space. And our guest happens to be a managing director there at Enverus, a fellow named Dane Gregoris. Welcome, Dane.
Thanks, David. Great to be here.
Thank you. I really appreciate you being here. You put out this fascinating full North American inventory of the shale basins in North America here recently, and the numbers in it are so really, frankly, impressive and stunning almost that I was really anxious to talk to you about it. I wanted to start, though, before we get into that, by letting you just talk about what your role is at Enverus, how long you've been there, and all that good kind of thing.
Yeah, excellent. Well, it's great to be here with you, David. So thanks so much for having me. I've been a part of Enverus and sort of predecessor firms for the better part of 8 years now. And prior to that, I worked at an E&P company here in Calgary, formerly known as Encana. And then did a little stint at a reserve auditor as well prior to that. Here in Calgary. So it's been I just started a part of ITG, which turned into RS, which turned into Enverus over the last 8 years. It's been quite a ride. But I've always really focused on mainly the US shale basins, and have worked with kind of numerous institutional investors on helping them frame the opportunities in the North American E&P space. As well as a growing number of corporate clients, as now we're part of a much larger firm with a much broader reach, and it's been awesome. It's been an interesting time to start a career as a research analyst over the last decade. It hasn't been the most fun, but it feels like the last couple of years, the optimism feeling today is kind of offset the previous years of drudgery. So it's an exciting time.
Yeah, boy, the last 10 years have been an incredible time. You got in right as the Permian was starting to boom, really 10 years ago, and the Eagle Ford was in full bloom, and Basin shale as well. And gosh, so much has happened. It's really been incredible. I used to tell audiences when I would speak to them 5-10 years ago, I wish I was 20 years younger so that I could be in the industry throughout the full development of these resources, because it really is exciting to me. Talk about there in Enverus. What was the motivating factor behind wanting to put this report together? First of all,
yeah, for sure. I mean, frankly, a lot of it is client interest. We've had, I think, over the course of this year, and sort of building through last year, the number one question we're getting from both our institutional clients, folks that manage money, or on the corporate side is, as activity levels have increased in the US, the question is, okay, how sustainable is this, right? How much growth are we going to deliver, and for how long? And so whether it's a pipeline project, whether it's underwriting an E&P deal, whether it's just trying to understand the duration of some of these shareholder friendly, whether it's a dividend program or a share buyback program, a lot of folks are trying to understand how long can E&Ps can keep this up before inventory degrades, capital efficiency worsens, and maybe some of these, great great moves that the E&Ps are making may not last forever, because everybody knows it's sort of a finite resource business. So a lot of the conversations sort of around that, and I think even over the last few months, we've heard, as U.S. oil production has underperformed many folks' expectations, including ours, frankly, this year. A lot of people are saying, well, if well productivity is coming down, does that mean there's no more inventory? It's, and the dire predictions that we hear sometimes in the market is that it's over, right? The U.S. doesn't have any more resource, and
it's like peak oil theory, pops up every 2 or 3 years.
Yeah, exactly. This is it for shale. You're seeing gas grow, oil not grow as much. So the gores are expanding, everything's going to fall apart. And so we hear that frequently. So this was sort of, this was a culmination of work that we've done over the last year and a half. We've stuck up every major basin. When I say stick up, I just mean adding locations spatially across North America and geospatially, so down section as well. And quantifying each remaining stick with what we think is a reasonable estimation for EUR on an oil and gas basis, and then adding a CapEx, OpEx assumptions to those resource estimates to come up with what is the break even or quality of the remaining locations across the U.S. And I think it's a fairly exhaustive analysis, at least of the major basins. There's certainly a lot of other basins that we weren't able to do in as much granularity, but for the major basins, I mean, it suggests that there is quite a bit of remaining resource still left in the Permian, sort of beyond a decade. And then in the, every other kind of major basin, you're starting to see, maybe outside of the Montney here in Canada, you're starting to see some inventory issues sort of by the end of the decade, we think, at today's activity level. So it's not quite as dire as maybe some of the industry analysts are talking about in the U.S., but there is some inventory challenges that we'll feel over the medium term, we feel.
Yeah. And that was but before we get into that, let's just kind of review what the major findings are. You just the top line numbers are 125,000 undeveloped drilling locations amounting to 60 billion barrels of untapped oil and 320 trillion cubic feet of undeveloped natural gas in North America, not just the United States, but the US and Canada. And that's just in the shale basins, correct?
That's correct.
And right. And so, but your quote, and I think it's worth emphasizing the main quote you have in there, and that is, we believe the fear around near-term shale drilling inventory exhaustion is largely overblown. And you go forward and differentiate that, though, between corporate producers and privately held E&Ps. Talk about that a little bit.
Yeah, absolutely. Yeah, so we do see a pretty big discrepancy. So we have this sort of inventory model where we have remaining locations across all of these North American shale basins. And what we find is when you intersect that with operator land positions and the leasehold that operators hold in North America, and particularly in the US, you see that the vast majority of the resource is held in public company hands. Right. So these publics have gone out, they've done a lot of M&A, they've had a lot of legacy businesses, that were legacy land positions in largely the Permian Basin that have existed for 20, 30 years in some cases, that have a lot of land. And when we compare the privates to publics, and including the sort of bigger super majors and integrated into the publics, I mean, the publics are in a lot better shape. These larger businesses, have well in excess of 10 years in most cases of we think reasonable quality inventory. We're not saying that every well that EOG or Chevron or Exxon in the Delaware Basin for the next 15 years is going to be 100 barrels a foot in the Delaware. We don't think that's the case on an oil EUR basis. It's probably going to be sort of between maybe around 70 barrels a foot, but we think they can do that for a long time. They got a lot of land, so that'll last for well in excess of a decade in our view. And then on the private side, so 50% of the activity in the Permian Basin today is private drillers, and when we look at the private inventory, that is not nearly as long lasting. That's more like 5 years or so. And if you look at just the private equity back folks. So these are, firms that have, likely startup firms over the last decade that are funded by large, oil and gas private equity firms. I mean, that's even shorter, 3 to 4 years in many cases, based on our estimations, is sort of an aggregate. So they're running full out today, capturing as much, converting as much PUD resource into PDP resource, and distributing as much cash as possible.
Yeah.
Which is a very different model than what we see in the public space today, which is very much,
very different. Yes.
Very long inventory lives, slower activity, and limited growth.
Yeah. And so when you look at another really interesting aspect of all this to me is those big numbers we're talking about. You guys used a $40 WTI price, just in terms of these are all barrels and TCF of gas that are economic at $40 WTI, correct?
Yeah. So we think about 60 billion barrels in the US are economic below $40 on a 10% rate of return basis. And certainly the industry hurdle rate today is much higher than 10%. We were kind of joking, but not really joking, in the office yesterday, that the hurdle rate of the industry today is probably close to 100%. I don't think wells aren't getting drilled today if they're not generating 100% half cycle IRR. So it's definitely a low bar that we're running, but it gives you a sense of the strong economics that exist across at these oil prices. So it certainly is compelling, and there's certainly lots of money to be made across the US.
Yeah. So would those resource numbers necessarily rise if you put in a long-term price assumption, say $60 or $80 a barrel? Those numbers would get substantially larger, correct?
Yeah, no doubt, for sure. I mean, we definitely think those numbers expand, and probably expand more than even we're modeling, right? Like, it's easy to add another 20 billion barrels, on top of that 60. If you add another $20 to oil price, that's fairly straightforward. But that doesn't include, really sort of unmodeled resource. So like, there's probably a lot of vertical plays start working. There's probably additional zones perhaps in the Permian Basin that start working. There's a lot of marginal resource out there. It opens up a lot more in the Powder River that we're probably really conservative on. Certainly a lot in Canada as well. So there's definitely some conservatism baked in, especially as you escalate the commodity price. We're sort of modeling the world as it's operating today, as opposed to, if the industry changes its tenor, if you will, and starts allocating capital for wells that can deliver a 30% half cycle return, there's a whole basket of opportunities that would be additional to our numbers.
One of the other aspects of your report, you talk about, how such a high percentage of these 125,000 undeveloped locations that are economic at $40 WTI, they're in the Permian Basin where oil's concerned, right? Talk about the magnitude of the Permian Basin when you get down into those lower prices compared to other basins.
Yeah, it's pretty insane. I mean, if you look at the entire US sort of sub 40, so that's 60 billion barrels, right? It's a sub $40 WTI, 10% rate of return. So the real highest quality, really rock in North America from an oil perspective, 85% of it is within the Midland and Delaware Basin. So the US oil story is a Permian oil story.
Yeah,
that's really the reality of, anytime somebody talks about US oil growth going forward, it's going to be Permian dominated.
What about natural gas? Does the Marcellus have a similar position where natural gas is concerned?
For sure, yeah. So the way we kind of break out the gas base is there's a bit of a difference. I wouldn't say that Marcellus and Permian are quite the same from the size of resource. Certainly from a PDP standpoint, it's there, but the Permian also has a lot of gas. So we estimate about 320 TCF of gas is available sub $0 Henry Hub, right? So this is gas that you don't need the natural gas revenue to generate a return. So there's a ton of that in in the Permian Basin today, so 320 TCF. But then there's 815 TCF of Haynesville, Appalachia gas that sits below $3 Henry Hub. So
Wow.
there's a lot of incremental gas resource we believe, particularly in Appalachia and in the Haynesville. And given the infrastructure constraints in Appalachia, it's you're going to need far more infrastructure projects to actually get that basin to grow materially, and we're not really anticipating that. So we kind of view the gas base, at least the gas growth story in the U.S., to be a Permian and Haynesville story for the most part, and really the Permian at the very low end of the cost curve, because it doesn't need really any gas price to make gas grow. In the Permian Basin, you just need an oil price, and then the Haynesville being kind of the marginal grower. So we expect if Henry Hub prices are high, you're going to see rig counts elevated. That basin, adding as much gas as it can. It's infrastructure constraints.
So there's been. Oh, okay. Go ahead. Sorry.
Yeah, and then I was just saying, as gas prices come down, that's going to be the sort of the U.S. moderator of that gas prices in our view.
So before I so rudely interrupted you there, you had just talked about infrastructure constraints. Of course, we had this situation recently where the WTI price briefly hit zero. No, the Waha natural gas price recently went to zero one day due to lack of takeaway capacity, right? Pipeline capacity. Talk about how that's impacting not just in the Permian at Waha, but really in the Marcellus Basin as well, where natural gas is concerned.
Yeah, for sure. I mean, infrastructure is so critical to gas, and it's a tricky commodity to move. I mean, you need infrastructure, and you need a lot of regulatory support to get infrastructure built, and you need capital to want to build it. So the situation in the Permian Basin is certainly pretty constrained. We think there's maybe some near-term relief there. We think that the negative prices recently were driven by some maintenance events. But as those are resolved, you're growing Permian Basin gas, and there's only a handful of projects announced over the next few years to add additional capacity for gas takeaway out of the Permian. And so we think it's going to be, it's fair to think about Permian Basin gas to be relatively constrained for the next 4 or 5 years. Every pipe that they're going to add, at least based on our supply forecast, which is not super high, maybe 500,000 barrels a day growth. Every incremental, you're going to add 1.5 BCF of gas a year probably out of the Permian Basin. So you just need more and more pipe.
That's so phenomenal to me. It was just 2017 when the industry really started to build out a ton of new pipeline capacity, and by 2020, people were talking about, well, we've got a surplus of pipeline capacity for both oil and natural gas, and now we're back into a constrained situation again. I mean, that just shows people, I think, the pace of growth in the Permian Basin has just been astonishing. I've honestly been associated with the industry for 3 years now, and there's just never been anything quite like it in North America, has there?
I don't think so. I don't know if there's anything quite like it in the world, frankly.
Yeah.
I guess probably the most important basin in the world.
It really is.
Point. A good thing to think about. So we think, the Permian Basin's doing, it's probably in our modeling around 16 BCF a day, right? So that's half of Appalachia production is coming out of the Permian and growing. So we could see it, over 20 BCF a day, by the decade.
And it's the second largest natural gas producing basin in the country, and it's bigger than the Haynesville by far, right?
Yeah, it's probably bigger today. That's right.
People simply don't really, most people don't really think about the magnitude of the gas production coming out of the Permian. It's
and it
stunning.
keeps the growth is like in 2017 it was only 4 BCF a day.
Yeah.
And now we're over almost 20.
Before we started recording, you and I were chatting a bit and talking about per well recovery rates,
Mhm.
not just in the Permian, but just in shale in general. And, they've always grown over time. Every time somebody has raised this alarm about, oh my gosh, per well recovery rates are going to plummet now. And they've always continued to grow. But then you mentioned before we started here that really this year we've started to see some diminution in that. Talk about what y'all are seeing at Enverus.
Yeah, for sure. So, this year, obviously the industry's added a lot of activity, right? Obviously, the rigs increased
Yeah.
quite substantially through the year. Frackers get added to a point where we're pretty much tapped out fracker capacity in the U.S. And so, with that additions, we've seen what we think is low grading, if you will. So you look at the average Permian Basin type curve this year, 2022 compared to last year, and it's about 5% worse on an oil basis. At least peak rate is probably as good as we're going to get with the early data, and that's not even normalizing for on a per foot. It's just it's a 5% worse. So even though lateral's gone up maybe a little bit, maybe 50 feet on average, certainly the lateral length curve is slowing, but if you can see that the type curve kind of march up every year since 2012 on an average basis in the Permian Basin, and this year it's down a little bit, which is a change, definitely an important change. And I think when we believe that change is caused by low grading from all these privates adding a bunch of activity and figure not as high quality areas, but still very economic at today's prices, very rational capital allocation decisions. And then even some of the large operators, Pioneers talked a lot about it.
Right.
EOG, we've seen well productivity come down as they add more intervals into their stack of resource, and it's just contributing to bigger MPVs on a per section basis, longer inventory lives, but that average well productivity on an annual basis comes down a bit.
Yeah. So where does it go from here? What do y'all see as the outlook for next year? I mean, do you think that is going to become a lingering trend where the Permian and other basins are concerned?
I think if the industry is still kind of running full out and adding activity, I believe you're probably going to see a little bit of deterioration next year as well. I mean, you've had a ton of private activity been added this year, and the completions of those rig adds, the proportion of completions next year that are going to be driven by private drilling is going to be higher again. So I wouldn't be surprised to see another, call it 2-3% reduction in average Permian well productivity. That wouldn't surprise me. So I think you're probably going to level out at some point,
Right.
unless you add a bunch more activity. Or reduce it. I think if you reduce the activity, average well probably goes up a little bit, but it's pretty steady. We don't think it falls off a cliff. We're not in that camp. We think there's a lot of resource still left to drill, but certainly as you add activity and these operators are adding wells in existing DSUs that have producing wells, you're not going to see the same 100 barrel a foot parent well performance that we've seen in say 2017.
So the industry periodically takes heat for not increasing overall production as rapidly as the Biden administration would like. This is on the days when they're not, bragging about trying to kill the industry. They complain that it doesn't produce enough. So what's the outlook for next year? I mean, do you think we've kind of leveled off in the rig count, and then it increased for actually fairly substantially for a while in October? But I mean, what about when these corporate producers go into their new budget year? Are you anticipating any kind of a significant run up in the rig count, which is still significantly below where it was before COVID? Do you think we will see a significant hike in the rig count next year?
We have we're kind of modeling very moderate gains in the rig count, and it's really driven by the service market being tight. I don't think big public producers outside of maybe the super majors, are going to be adding a ton of net rigs to their program. They might be adding a lot of DUCs were completed this year on a relative basis, so they might need to add a bit of rig capacity to maintain a similar kind of completion cadence year on year for the vast majority of independent publics. The supers, have big Permian Basin growth aspirations.
Right,
Both
Chevron and Exxon particularly,
Chevron.
right? Yeah.
Exactly. And I think they're sort of tempering expectations this quarter. They've sort of said, probably not gonna be 25% growth, maybe it'll be 20% growth. So I think they're seeing the service tightness as well. But I do think that if you look at the long range plan, you look at their portfolio and where they're going to be adding oil production, to offset declines elsewhere in their portfolio.
Yeah.
The Permian Basin is where they're adding production massively, apart from in Brazil, Guyana. So you have a consistent ramp, required for those supers to continue to add production in the way they want. And I think they'll probably be taking share of maybe some of the private activity too, as inventory levels for the private operators starts to dwindle, or they transact, right? So with any of these private to public transactions, typically the rig count is reduced after the transaction. So that makes, frees up a rig, maybe a frac crew that a super major or another operator take advantage of.
So one last question, but before we have to wrap up, we're running out of time. But on natural gas, of course, our industry is under, some pressure to increase production to help supply Europe with LNG over this winter and really over the next several years. LNG is going to be in huge demand in Europe, Asia, and everywhere. Is there a prospect for natural gas production to have a significant increase next year from North America, not just the U.S., but all of North America?
Yeah, we think it'll grow. I think there's bottlenecks, right? Whether we talk about Permian Basin infrastructure constraints, Appalachian infrastructure constraints, and even constraints in the Haynesville. Frankly, are even though there's more and more pipe, and it's a lot easier to get a pipe built from North Louisiana to South Louisiana or into Texas. Yeah. It's a shorter pipe and a lot more friendly regulatory environment. So that's going to happen, and you're going to see gas growth next year. We probably think it's not going to be as high as it was this year. This year was a banner year, right? 3.5 BCF a day or so. Maybe next year we're sort of modeling at 3.5 or so. And we think that's going to be in some cases driven by a reduction in the rig count. So the Permian Basin's adding so much gas. Haynesville's adding gas this year. We're probably going to see some softening of Henry Hub, we believe, over the next 2 years, just because the LNG demand curve, we had real steady growth from 17 to 22, and then it's pretty flat. And then the next wave of projects comes online in 2025.
Right.
Where we're going to be adding, call it 10 BCF a day of capacity over 3 years, which is a massive amount of gas export growth. And so with the view on Henry is that, maybe it needs to moderate near term so that producers don't, start to grow too much, and we hit storage levels in the US. And so gas growth kind of moderates and then follows the LNG export capacity curve. When we hit 2025, 2026, we're adding a lot of LNG capacity, and price is going to have to rise in our view to incentivize a significant amount of non-Permian gas growth, which is probably going to be the Haynesville.
So are the other demand drivers for natural gas continuing to rise in the U.S.? Power generation, manufacturing, chemical, is all that still ramping up here in the United States?
Yeah, we're modeling a little bit. It's not huge. It's sort of in the range of half a B to a B of gas. I think there's good narrative around moving industrial capacity into the U.S. because of lower gas prices than in Europe. So we might see more than what we're modeling over the next few years. I'm just not sure how fast those decisions get made. And certainly with, $6 or $7 prevailing gas prices, if gas goes back to 3 or 4, there's even more compelling reasons to bring industrial capacity to invest to take advantage of really low prices relative to Europe. So I think it's going to grow a little bit in the industrial space, but it's not nearly as big of a driver on the demand side as LNG export capacity.
Yeah. So what's next? What are you working on next? You want to plug something in advance of release so I'll know about it?
Yeah, I mean, we're doing a lot of work now on sort of really, we've done a lot of the inventory work, but a lot of the questions we're getting from clients now is sort of how does that cost curve evolve, right? Getting a better understanding of inventory depletion and on a temporal basis. So, is the marginal cost of the Permian Basin going to increase every year, right? So to my earlier point on, you're probably going to see a little bit of well productivity reduction next year. Does it get worse next year, the year after that? Like really getting a better handle on how the next few years play out from a well productivity standpoint is, I think, top of mind for our clients and internally here.
Yeah. Is that going to be public? Is there be a public release on that?
I can't say for now.
Okay.
But yeah.
Well, I got to be nosy. I got to try, So
I appreciate that.
Any of our viewers want to get a hold of this report or get in touch with you, where can they do it?
Yeah, they can reach out to me on LinkedIn, send me an email at enverus.com, or reach out to, we have a marketing group and we're a pretty big firm. So there's lots of tentacles throughout the industry. Usually they can find somebody at Enverus to reach out, and I'm happy to answer any questions.
Excellent. Hey, man, thank you so much for being on. I look forward to talking to you again when your next report comes out.
Excellent. Well, thanks so much for having me, Dave. Great to meet you.
Thanks. And thanks to the Sandstone Group and Stu Turley for being our host today, and Enverus, of course, for sponsoring our podcast, and to our producer, Eric Perrell. This is David Blackman signing off, and we'll talk to you next time.